This is the basic trial account that you'd see for Power Options. If you're just starting out on your 14-day free trial, I want to encourage you to follow the 4 steps that are listed there. You want to make sure that you take advantage of the quick start guide, go through some of the flash tutorials. You also will want to check out the archived webinars in the free webinars section. We have various webinars during the week. Want to make sure you take care of those. And of course, the free coaching sessions as well. You want to make sure that you get signed up for that during your 14-day free trial, or if you just converted from a trial to a subscription, if you have any lingering questions, and that's what the coaching session is designed for as well. Down below, of course, we just have our basic pods here, data pods. The market sentiment, of course, this is going to update while we're on the webinar. We'll come back to the market sentiment tool. We were showing a light buy as of the close of yesterday, and believe me, that was relevant as of this morning. This morning, for example, I had CalMaine here. Oh, there it is. CalMaine had jumped up about $1.10. It was trading at around 58.20, 58.25. At one point, CAR was up about 95 cents, almost $1. E-Trade was almost up $1. Black Hawk, I think, was up about 80 cents, so on and so forth. AGO had jumped up above 26 and then pulled back. So a lot of things had pulled back. STX just randomly, that one surprised me. I thought it was going to be up today, and it was actually by about 5 or 6 cents, and then it just got pummeled later on. Anyway, long story short, the data pods here you can select so you can get a basic market view when you first log on. When I first log on to Power Options, I take a look at the market sentiment from the close the day before. I'll look at the market activity for the basic indexes and the VIX, just see what the market movement's doing right at the open. We have other data pods you can select, ex-dividends, earnings announced today, for example, stocks hitting their new 52-week highs or 52-week lows, top stock gainers and losers, as well as the top industry gainers and losers as well. And then, of course, the ETF gainers and losers, that's another one I usually keep up here just to see how the broad-based ETFs are changing, mostly also relate to the market activity, but you'll typically always see some of the 2 times and 3 times ETFs thrown in there as well. So it's a very useful thing. When I log into Power Options, that's the first thing I just check to get a general market overview. I navigate right over to the portfolio tools so that I can see where my positions currently stand. Now, this question that just came in here is related a little bit to the portfolio, but it's also related to credit spreads. I mean, the first question that came in, is from Robert. And Robert says, what is a good approach to exit a vertical spread because it is going the wrong way, and how to set up the alerts in the portfolio? Okay, before I go into anything, I know there were some issues with the playback of this video earlier, but if you haven't yet, Robert, go into the free webinars tab, go under the options strategies section. There's a full hour and 20-minute video here on managing your spread positions. It had some playback issues earlier this week. Those seem to have been fixed. I was able to load it yesterday and Wednesday and watch it a few times. So eventually you're going to want to check out that. We go through the full combination of credit spreads and debit spreads. The 6 kind of ways I look to manage a credit spread if it's moved against me. And of course, maybe the 5 or 6 ways, really 4 or 5 ways to manage a debit spread if it is moved against me. But that doesn't relate to your question right now. It does, but it doesn't. Let's talk about your question. I'm going to create a basic portfolio right now from scratch. So we're just going to go into the My Portfolio tab. I'm going to do this first. I'm going to go into Setup. And you see we have comparing SPY spreads that was created a couple weeks ago during a presentation, our Friday presentation, I believe. Radioactive trading webinar, some other comparisons we did in different webinars. We're going to create one here that's just called Spread Management. Okay, and I'm going to use stocks. Normally when I trade vertical spreads, I'm only using the broad-based ETFs and indexes. I don't have a current spread open right now in this market. Ernie has a couple open, I believe. I don't have any. Let me just start this off with a simple number of $25,000. We'll copy that over, and we're going to start this last week on around September 16th. Okay, so let me just save that portfolio first. And what I'm going to do from scratch is I'm going to go ahead and create a bull put credit spread. And I'm going to look up some of the historical data from September 16th just to see what we could find. on two positions of mine. Let's see, that one's moved up now, so I'd do the bear call on that one. So let's say we did a 57.5, 60. Okay, so what I want to do is go back to September 16th. I'm going to look up stock STX. It's one of the ones I'm in as a married put position. It's been having issues recently. I'm going to go to the current chain. The stock's currently at 42.89. This does offer weekly options. So let's go back to September 16th. I'm going to go back to the historical chain, Robert. Let's go ahead and take a look there. Now, today's expiration is, of course, the 25th. So we're going to say for next week, the October 2nd. On September 16th, 16 days away on October 2nd, our STX stock was trading at 49.15. At the time, let's just look at the put chain here. We're going to do a bull put. At the time, I might have wanted to go close to 10% out of the money, almost 5 points out of the money, and I would have looked to sell in the weekly options, maybe the 44 put. I got to go to a bigger chain. Let's go to the medium chain here. May have looked to sell the 44 put, and let's keep it a simple $2 strike difference and use the 42. Now, these numbers look bad at the time. 16-day trade. Let me highlight this a little bit better for you. There we go. So roughly 5 points out of the money, just about 10%. We'd be looking at the 44, and I'm going to keep a standard 2-point spread. So we're going to look to do a bull put, the 44 strike, selling to open the 44 put, and buying to open the 42. It'd be a 2-point spread. The natural bid and ask wouldn't result in a natural credit. We'd actually have a debit of 8 cents. But with a natural bid on the close of September 16th of 19 cents, and the bid at 19 and the ask at 36, we're looking at about a 17-cent difference. Let's call it a 9-cent difference. So we're going to be aggressive and say that we got 28 cents for the short put, or 44. Okay, and at the same time, between 9 and 27, again, we're looking at about 18 cents. So we're going to say we paid 18 cents here. So we're roughly 10% out of the money. We're 10.5% out of the money here using the 44 and the 42. So we're pretty deep out of the money on the spread at the time. And if you notice, the theoretical probability above that the stock would stay above 44 on October 2nd on September 16th was 95.5%. So we're willing to take only that 10-cent net credit between the bid and ask. Sell at 28, buy at 18. We're taking a 10-cent net credit for this very high probability. All right, now let's enter that into the portfolio. So I'm going to go back to the portfolio now. Let me clear up our drawings. And I need to add this position from scratch. So I'm just going to go into Select Strategy. I'm going to select Bull Put Credit. Okay, now our buy option, we're buying the October 2nd weekly 42 strike put. Buy to open, let's say 10, so we can make it worthwhile for our premiums. We're going to keep this as a paper trade, so 0 commissions. And we bought into the 42 at 18 cents using the midpoint. Now, let's say that we were lucky enough to be aggressive, and during the trading day, we were able to sell to open the October 44 put. I'm going to change the dates here on both these to September 16th. All right, no commission, and I got to change my price to what I would have received, 0.28. We're going to do 10 contracts a piece, so we're going to get about $100 net credit. 10 contracts times 2 is going to be about $2,000. So we're looking at about a 2% yield, essentially, on this position. Okay, so, I'm sorry, it came out to about 5.3. I did that wrong in my head, I apologize. So we're looking at about $100 net credit with a risk of about, the 10 cents, so $1.90 is about $1,900, okay? So we're looking for about a 5.3% yield. We had a 95.5% probability. Let's ignore what it's showing us now where everything is. I'm going to go into the alerts. In general, Robert, when I open, this is a bull put credit spread. When I open any credit spread, a bull put credit or a bear call credit, one of my stops is I'm going to look to manage the position if the stock reaches within 1 or 1.5% of my short put strike price. So my lower limit with my 44 puts sold would probably have been about 44.40. And then I'd mark that as a red indicator. Okay, so 1% of 44 would be about 44 cents. Maybe I'll even put it at 44.45. Okay, so it's the 1% stop rule. If the stock reaches within 1% of your short put strike price or your short call strike price, that's when you may look to manage it. A stock percent change, you can use this. I usually just focus on the short option, but if you got into the position, we saw on the chain historically we were 10.5% out of the money, so I may want to be notified if the stock dropped by 5 or 6%. Now, I didn't put in the stock price at time of trade. I think it grabbed today's price at 42.89. I didn't put in that it was 49.15, so I'm not going to enter this field right now. Okay, if I had put in when I entered the trade that the stock price at the time of trade is 49.15 and I put in an 8% decrease, that alert would have triggered as well, of course, because we're down to $42. But I'm going to leave that alone, but that's another alert you could set. Okay, you know, Robert, if you're looking at 8 or 10% out of the money, I think we had talked earlier how you're looking for a 10% to break even range. Well, you might want to be notified if the stock drops 9%. That might be one of the alerts. And the upper limit I'm not going to worry about. Okay. Some investors, let's just talk about the bull put credit spread. And for those of you who may not be familiar, remember we sold the 44 and we bought the 42. Okay, so this created a bull put credit spread. We took it a 10-cent net credit, and we have a max risk of $1.90. As long as the stock stays above 44, both puts expire worthless, and we keep the net credit. The stock drops below 42. We have to close out the position for the $2 loss. We keep that initial 10-cent net credit, so we have a loss of $1.90. We're well above the 10-to-1 risk-reward ratio, which I usually like to keep it. The 10-to-1 risk-reward ratio on any credit spread usually means you're looking at about an 11% gain, roughly an 8 to 11% gain with the leverage, and you're probably in the 75 to 85% probability range. We went above that to 95%, which is why we're taking a much lower net credit. Okay, but I'm not going to worry about the upper limit of the stock price or the stock price change to the increase, because when I opened the spread, I wanted the maximum to happen, meaning that I wanted the stock to be above 44, so both options would expire worthless and we'd receive the full net credit. I'm not really concerned if it's at 56, 58, or 59. The reason why is if it jumped up to, let's say, even 58 today, the market maker would still hold some premium on these positions. In order to receive the full credit I was expecting, this position, I need both options to expire worthless, holding them all the way to expiration and not pay a closing fee, perhaps. And that's the only time you realize the maximum profit without any buyback is at expiration, when all the time value has decayed out of the options, but they're still out of the money. Okay, so that being said, we've set our lower alert for what I'd look for on the stock price trigger, within 1 or 1.5% of my short option. If it was a bear call, we would have put it to the upper limit. All right, days remaining to expiration. I don't usually mess around with this too much. It's a good thing to set an alert, then to be notified if you're within 2 days to expiration or so, or maybe 3 days. And I say that to those of you who are trading weekly options, and you may be tracking positions in your portfolio. We have several bull put spreads, some that expired this week, some that expire next week, and some that expire maybe on the standard October expiration. So it's an easy filter to say, okay, on the Wednesday or Thursday before your Friday expiration, just to be notified, okay, these are the ones here that are going to expire in the next 2 days. I'll worry about the other ones later on unless they're really being threatened or another alert has been triggered. Okay, you can set limits also on the bid or ask value, depending on if it's the sold or the bought option. I tend, again, not to mess around with those because my real focus is the spread itself, where it's getting threatened. It's not a bad idea. Okay, so this one here, I'd focus on the 44 put. We know we sold it for 28 cents. If the time value, meaning it's still out of the money, or just the extrinsic value, reaches a certain range that's maybe double or triple that. So if the upper limit of the ask price, the likely price I would pay, or the worst case scenario, but the likely price I might pay close to buy to close my 44 put, which is the important one in the spread. The short option in the credit spread is the important one. I may set that to be double or triple what I received. In this case, I'll go triple because I was so far out of the money. So I'll set that to be about 84 cents. Okay, so yeah, 0.84. I know all of these are going to, shame on me, 0.84. And I'm going to mark that as a red alert because that means that my put option has increased 3 times of what I originally received for it, okay? And that's probably because the stock has fallen or maybe implied volatility has jumped for some reason and the option has increased in price. Of course, the percent position change. Here's another one you might want to set, Robert. Based on the credit we received of 10 cents here, if the position decreased by 50% or maybe even 75% because we're so far out of the money, give ourselves a little bit more leeway, meaning that if my buyback cost is twice as much, for example, at 50%, or 3 times as much as what I originally received, I'd set that. And we know all 3 of these are going to be triggered just by where we saw the stock being, and then we're going to talk about other ones. Now let's talk about the fundamental criteria that are available, the fundamental and technical criteria available for stock. So far, we've just set what I like to use for the stock price range on a credit spread, within 1 or 1.5% if I'm close to earnings. If the ask price of the option that I sold goes up by more than 2 or 3%. Why the difference between the two? This one was so deep out of the money that I want to give it more leeway. Okay, I want to give it more leeway to allow it to go up 3 times. If I had sold a bull put credit spread when STX was at 49, and I had sold the 47.5 put or maybe the 45, and I only was 5% out of the money, that's when I might use the double range, okay? Because that means the stock falls quickly. I'm very close to that pivot point. I probably received $1 for the put premium. If it goes up to $2, I might look to manage it at that time. But since we are so far out of the money, I'm giving it more room to increase in price. But when you use the search tool to find your bull put spreads or bear calls, you probably put in criteria such as you wanted a minimum return of minimum probability of maybe 85 or 90% that the spread would expire worthless. Okay. You also probably put in some data that you wanted the stock to maybe have a for a bull put to be trading above the 20-day or 50-day moving average. You may have used MACD, you may have used Bollinger Bands as well. Well, if I use any of those criteria that are here as part of my search, I'm also going to use them as part of my alerts. So if I ran the search and on September 16th, when I identified this bull put on STX, the stock was trading above the 20-day moving average, one of the alerts I'd set is if that trend reverse. If the stock now drops below the SMA 20, I'm going to mark that as a red flag that I'm going to look to manage the position. If you use Bollinger Bands for a bull put, I might have wanted to look for stocks that were near the upper Bollinger Band, so I'd probably want to be notified in a bull put if the stock drops below the lower band. Okay. In any spread position, I always run the search and I look for positions, a credit spread that does not have earnings between now and expiration. But it never hurts that if you wanted to put in a field where you want to be notified if you're within 3 days to earnings. I do this on my married put, my radioactive trade, so that I can look to maybe make an adjustment as I'm coming up to earnings, whether I need to or not, just to maybe give myself a little bit more protection. We can talk about the one I did today later if you guys want to. Kind of complex. And then days until ex-dividend. I do this if I have a short call open on one of my married puts, a collar that I'm trading long term. I don't do covered calls anymore because of the downside risk factor, and I was never successful with them in the first 18 months that I was trading. But you can set the days until earnings as well. But for credit spreads, Robert, one quick review again. Anything that's available here that you used in your search, if you use the Bollinger Bands or if you use the 20 or 50-day moving average, set the opposite here. Okay, so be notified if the stock drops below the 20-day if you originally look for stocks in an uptrend. The position change, increase or decrease, increase is okay too. There's always that 80-20 rule. With our spread we're examining today, with only that 10-cent net credit, still potentially a 5% return with a 95% probability from September 16th. If I reached 80%, could buy it back, I'd still probably just let it expire next week rather than paying any more commissions to close the spread at this time. Perhaps. The upper limit, okay, this is what's discussed in that webinar I mentioned earlier as well. One of the trigger points in addition to looking for stocks, if the stock drops to within 1 or 1.5% of that short put strike price, also the bid price or the debit of the position. The debit to close is what I mean, Robert. So if we originally took in that 10 cents, let's use a better example. If I originally took in 50 cents net credit for a position with a less of a probability, not as deep out of the money here. I took in a 50-cent net credit. I probably would look to close the position if the debit to buy to close my short put and sell to close my long put was greater than $1, or twice as much as I originally had. Here I just used it on the ask time value of my 44 put, the short option, my pivot point, and I set that to be 3 times of what I originally received in credit for that option. And then of course we talked about the stock price range. That's typically the ones that I start off with. All right. Now I'm going to go ahead and save those alerts now in the portfolio, and we're just going to see red everywhere once we go back to the portfolio. We've hit our lower stop limit, of course. The short put has moved beyond 3 times of what we originally received for it. And of course, we're probably below the SMA 20 by a ton at this point. Something I was looking at earlier, I should have done a different adjustment on my STX married put position, and I didn't. I still have time to do it. It's not a big rush. But in any way, what we're seeing here is, of course, we originally received that 10 cents net credit, but it would cost us almost $1.10, $1.08, $1.10 to buy to close this position. We did 10 contracts. So I scroll over here. Sorry, I'm looking at the position analysis view, where it gives me not only each individual leg, but shows me the breakdown of the current position. My original expectation was to make $100 if everything expired worthless, which was 5.3% of what we invested into the position. Right now, if I liquidated the position, well, it would cost us $940. Now, what that means is the debit to close this position here, this $1.10, minus the $100 we receive, would still cost us $940. Okay, and if we hold it all the way to expiration, we'll have a larger loss. This just assumes that the stock is trading at the same price at expiration. We're not projecting what your expiration loss is going to be. It's just saying if the stock stays at the same price, we'll have the maximum loss on the position, with the stock now trading at, oh no, we won't. I apologize, folks. The stock today is at 42.90 something, 42.89. So it's below our 44 strike, but above the 42. Okay, there we go. Page is refreshed. Now, let's go over to the profit and loss chart. Well, the first thing we're going to do, as I'm tracking the position in the portfolio, sometimes you'll see some good opportunities. What I'm going to do is link here. Anytime you're tracking any position in the portfolio, we can go to position actions and then position analysis. And it shows us the current breakdown of our position. Remember, this is a very large risk-reward profile. Much higher risk to reward because we went for that 95.5% probability and only took in a 10-cent premium. Break even was 43.90. We're about $1 below that, and we're almost within striking distance of our long put range to receive the maximum loss in the position. So as I scroll down, of course, it gives me what my original expected return was. We were hoping to make 5.3%. The current liquidation value we saw was 1,040. If I bought to close the short put now and sold to close my long put, it would cost me $10.40. I keep that initial 10 cents times 10 contracts, or $100, so our loss would be $940. Using the midpoint, get a little bit better break. This $10.40 is based on the natural bid and the natural ask. I scroll down below, and of course at expiration, we're going to receive that close to that maximum loss on the position. It was $1,900. And the stock stays right around 43 here. We don't get the full loss, but we're still going to have a significant loss to what we expected to make. Now, in most cases, a lot of times what you'll see here in this section, right underneath that future expiration value, will be a field above the history for rollout opportunities. We don't see any here, but that's okay. All right, we can still do these manually. We can evaluate rollout opportunities manually, and we're going to discuss that in just a moment. Okay, so let me erase that drawing there. And I just got to mark down this number here. So the midpoint loss we saw would have been $880. It would cost us $980 to close, but we keep the $100 for our 10 contracts. We'd have a true loss of $880 if we close the position right now. Back to the main area. There we go. Now, so I don't see any rollout opportunities. What I'm going to do is come back to this profit and loss chart, and we're going to go to what if calculations. Simple view of what we were seeing before. It's the profit and loss chart for our bull put credit spread position, but now let's try to evaluate what are our options. Okay, and I'm going to go through these one at a time basically, and then we're going to come back and list them all for you just as a basic slide. Number one, what is our first option? liquidate and take the loss. Okay, remember we opened this position when it was at $49 per share, and now it's down to about $43 per share. So we were wrong on the direction of this position. I was actually bullish on this position too. When it dropped down to about 46, I actually made an adjustment thinking it would recover and go back to 49. Well, it clearly didn't. That's all right though. Let's take a look quickly before we go any further into that. Let's just go to the chart here. Let's go to big charts. I didn't save my settings. But yeah, when the stock dropped down to about 45, I thought it was going to recover to about 46 or 48, and it's just continued to move down. It was actually about 46 here at the beginning of September, and even back here because it did before. When it hit 46 in August, let's clear this up. Let's go to a 3-month chart here. Yeah, so when I've been in this position, when I saw it hit 46 and it kind of hit the lower Bollinger Band there, let me get that all set up for you. I'm going to set up an SMA 20, set up the Bollinger Bands, look at MACD, RSI, and just basic volume. There we go. All right. So when it dropped below the lower band here on or around end of August, I figured the stock was going to recover, and it did. It went back up to 50, hovered here around 49, and that's when we saw it the other day. It was at 49.50 on around September 16th, and then it just sort of dropped below the 20-day moving average and hasn't stopped since. The MACD really spread open here, and the RSI is really collapsing. Now, I'd mentioned that I was looking at an adjustment 2 days ago. It would have worked out for me, but if this goes back up on Monday, the adjustment I would have made yesterday or today would actually lose me money instead of making money. So I'm going to hold on to this one to see what starts happening next week. Although when I see this on the MACD crossover, I expect it to continue down in price consistently, and the fact that it's below both the lower Bollinger Band. Okay, so that's just what the chart has done recently, kind of fluctuating here, and now it's just taking a severe hit. Let's go back to the custom spread. Okay, so option number 1, liquidate and take the loss. I was wrong on the direction. It's not doing what I want. I've got 7 days remaining to expiration. Maybe I should just close it now, admit the loss of 880 instead of taking a higher loss later. If it continues to fall, I might realize that whole $1,900 loss on the bull put credit spread. I'm at half of that right now if I get closed at midpoint. So that's not a bad idea, taking half the potential loss, especially if I think the stock's going to continue to fall in price. Number 2, this is one I'm not fond of, but this is one of the most common ones that is available, that is discussed. Number 2, just like anything else, anyone with a blog who's traded bull put credit spreads, will say this is the easy way to adjust it. And the easy way to adjust it is liquidate your position now, so you realize that loss of 880, and just simply roll down your bull put further out in time to try to make up the loss. Well, if I closed right now, my loss was at 880 for 10 contracts. Okay, and we're talking here about 88 cents, essentially. Okay, so taking in that loss right now on this position, then trying to make it back, the stock's at 42.89, I'm just going to say, okay, I'm going to liquidate, and I'm going to sell lower and further out. Well, I'm going to need a net credit of roughly 78 cents or so to get me back to break even from taking in the loss of 880. That's if we close at midpoint right now, not the full loss, okay? So we have a loss of 880. I got to make that back. Oh, I'm sorry, the loss of 880 takes into account, my apologies, the loss of 880 takes into account the 100. So I need a net credit of 88 cents going further out in time. Entering another bull put credit spread on a stock that's clearly declining. That's the issue I have with simply closing it, looking to go further out in time. Could the stock recover? Absolutely. But I was wrong on the direction of the stock. But let's take a look. Knowing off the top of our heads that if we liquidated right now, we'd have that full loss of 880 on the position. So let me just clear out this. Now let's just quickly look at the options going out in time. So our bull puts failed. We liquidate it today. 10 contracts apiece on a 2-point spread. We have a loss of $880. So if I keep 10 contracts, we need an 88 cents and a 2-point spread. Why am I doing that? Well, let me go back. Right now I have roughly $1,900 in margin, close to $2,000 in margin into this position on hold in my account. I'm taking a loss of 880, but that leaves me with about $1,200 of that 1,900 or 2,000 I originally allocated for 10 contracts at a 2-point spread. Well, I may just look at a 1-point spread now because I only have $1,200 technically left on this position. but I probably most likely would try to keep that $2,000 in place. What I originally allocated to the position, I might have to add some more into it out of another position or from what I'm holding in my account. And since we took a large loss here, the stock's at 42.89, I might have to go out as far as October 23rd or October 30th, 30 days away or a little bit more, to try to find an 80-cent net credit. And I'm not going to have near the probability that I originally had of 95%. Well, we threw that out of the water anyway with the events of STX. But let's go ahead and go to October 30th. Happy Halloween. And let's take a look at our puts here and our 2-point spreads. Well, the 42, and there's another issue with this I'll address in a minute. At the end, the 42, bid of 179, of ask of 187. So let's go ahead and call this 183. So now I need a put to get that 88 cents back. I need a put that's less than $1 in price. In order to do that, it looks like I have to go down to the 35 put. This one here is at 111, 119. So I'd have to pay, let's call it 115. So we get 183 net credit for selling to open the 42 put and 115 midpoint for buying the 40 if we're keeping the 2-point spread. Okay, so let's do that. 42, 40. And okay, good. And let's go ahead and add in, we're going to sell the 42, buy the 40. Oh, I'm going to put 10 contracts again. Even though I only have $1,200 after I take the loss of the 2,000 I started with, we're going to add 800 more back in so we can cover this 2-point spread, but our requirement is going to drop down. So 183 and 115. Now, let's submit that. Okay, so we're taking in a net credit of 680, and the maximum risk is only 1320 because we're getting a decent net credit of 680 minus the 2,000, so we're at 1320. We only had $1,200 left, so we really only had to add 120 in of what we lost in the original position. But the max profit of this net credit's only 680. We're still $200 down, okay, from where we're at. We're at a loss of 880, even if the stock stays above 42 through October 30th. And remember, it's 42.89 and in a bad downtrend right now, okay? So that's kind of a concern here. We didn't quite get back to break even. Maybe we could go out further in time by rolling down to the 42, but what is the probability here? Okay, now October 30th, the probability, let's just go to the more information button for our 42 put. Let's go to research and option. This gives us all the information. I'm going to have to clear up these drawings. We'll write them back in later. All right, so our probability here above is only 56.2%. Now I know what you'd be saying, well, Mike, can I really put much stock in that because you originally showed a spread that had a 95.5% probability and now it's clearly in the money, so that isn't worth anything. Well, it's not every position that has that, of course. Most of the positions that show a 95% probability will have over 60 to 65, I think to 70% likelihood that they will expire worthless and still keep that close to 95% probability to get closer to earnings. Unexpected events, anything you can't write in. The market's been kind of strong than weak, STX just in the last 5 days, tech companies just showed a lot of weakness and has just been pummeled in the market. So rolling down to a new spread that's out of the money, just out of the money, selling the 42 put, buying the 40, gets us back most of that 880 loss we'd realize, okay? But at the same time, I'm sorry, we only have 56% probability. Now, whenever you're running a search or you're looking at the option chain or you're doing a search by symbol, you can select to see the probability of the options that you're viewing. When we're in the custom spread tool here, it's just showing the basic raw data of the numbers and calculations. In order to see the other data for any of the option or the stock that you're involved in with your management or what you're looking at, you want to use that more information button, go to research, and then go to option research. That'll link you to the page for that specific option we just saw, where it gives me all of the data for this particular put, applied volatilities, IV ranges, probability above or below, and even the price history of this option over the life of the option. So for October 30th option, since it was released, we have a graph of the historical data where we can take a look at option bid versus implied volatility or Black-Scholes, stock price, so on and so forth. So some different historical graphs here you can view on what's called the option research page as well. All right, so 1, liquidate, take the loss. No one really wants to do that, but sometimes it's just okay to do that because you don't want to take full loss. Remember, at a loss of 880 now, we're at about half of what our true loss would be if the stock drops below 42. We stay to expiration. All right, we're going to get away. I'm actually going to get away from this window. I'm sorry. Let's close that window, go back here, and go back to the what if calculations. There we go. All right, so here's our position ounce control. 1, liquidate. Number 2, liquidate and roll down and out. Of course, for a bear call spread, if I was in it and it got threatened, I would liquidate and roll up. Okay, here we're liquidating and rolling down with the bull put. Okay, now this can be profitable. This can get you back to break even potentially, but you have to be right on the direction of the stock. You're entering another bull put, and if everything that you're seeing on the stock chart indicates this is now going bearish, then that's probably not what you want to do. I don't want to be in a bullish. I don't want to try to catch the falling knife. It's falling. Robert says, does it show up in interest? Yeah, every piece of data that we have on PowerOptions for every individual option is available in that research page. Okay, delta, gamma, theta, vega, implied volatility ranges, last bid, ask, high, low, the open interest, volume, percent current option, volume, previous option, volume, all the liquidity, time value, percent time value rate of decay, SIV, all of that's available on that research page. Okay, so number 3, well, there's one way to look at this is some investors will say that, and we show this will show up in the rollout opportunities. Another thing I could do, I still have a couple weeks to go. This is our original position where I sold the 42 put, sold the 44 put and bought the 42 for next week's expiration. And one way I might look to try to manage this credit is to create a Condor. Well, that can work, but in order to make back the money that I'm losing on this position right now, $880, there's probably not a bear call available for next week's expiration that's not going to be more of a butterfly position. But there's not going to be one here that's going to help me get back to break even by creating a Condor. But let's go ahead and take a look, okay? Number 3. Creating a Condor to try to hedge the loss. We'll keep 10 contracts. You're going to have to put up another amount of margin, 2,000 or whatever it is between the spread. So we go to October 2nd. My stock is at 42.89 and falling like a rock. So maybe let's get aggressive. Let's sell the 43 call, 89 and 93 cents, easy enough. Let's call it 91 midpoint, and buy the 45 and keep the 2-point spread. I'm going to put that in at 23 cents, okay? So 91 and 23, 10-point contract. All right, so we want to sell the 43 call at 91, and we're going to buy the 45 at 23. Go ahead and submit that. This does not repair our position. In fact, in best case scenario, we get locked into a loss of 220. We just don't have the premiums to do it because it's gone between the two strike prices. In some instances, if the stock was trading, oh yeah, and the reason why this didn't work, of course, is because I sold a call below the put. That's one of the reasons. I have to go higher now. I have to go up to the 45, so I have a true iron Condor. I didn't think of that. Let's go ahead and change this now. Let's add in the 47 for October 2nd. We'll call that 8 cents. Okay, let's switch this. So we're going to sell that at 23, buy 10 at 8 cents. That's a better looking iron Condor, and yes, we could get it back to break even and still have a profit of $250, twice as much as what we originally expected with our first position. However, in order for that to happen, the stock has to now go up above 44 again. We didn't do anything to stop the downside loss. We hedged it a little bit. We could lose $1,900 on our original bull put credit spread. By taking the second credit, now we can only lose $1,750. We've done nothing to hedge this. We did increase the maximum profit, but that's only if the stock recovers. The only time you really want to do management number 3, creating a Condor, is if you've been in the position for 10 days, or you only have 10, 15 days left to expiration, and since you've been in the position, the stock has stayed right around where it was. So when I sold the 44 put and bought the 42, if STX was still around 45 or 45.50 right now, I may look to sell the 46 call and buy the 48 to complete an iron condor, because it looks like the stock's going to stagnate between those ranges for the next 16 days or so, or 7 days in this case. But as a repair, if it's already dropped below the short put strike price, that is not a good idea. All right. Now, that being said, what is the other options? You could liquidate and roll. We talked about some of the risks with that. If the stock does recover, it could be okay, but if it continues down, you could compound your losses by trying to manage it. Number 3, create a condor. Well, that really only works if it's been stagnating, not if it's fallen below the short put strike price. I just listed there because these are some of the ones that we cover in the other webinar. Number 4, well, how about closing my position that exists right now? So again, liquidate once more, taking the loss, but instead of repairing it with just rolling the put spread down and further out in time, how about attempting to repair it with a bear call a few weeks out in time? The stock clearly looks like it's moving down in price. The MACD has crossed over and is declining well below the lower Bollinger Band. It looks like it's going to continue to move down. So let's clear this out, our original position. And remember, if we liquidated right now, we'd have a loss of 880. So I'm going to go out again, try to go 30 days out to get a decent premium. We're going to go back to October 30th with the stock currently at 42.89. It's a tough one, but let's go ahead and sell the 44 call and buy the 46. Again, why am I keeping the $2 strike difference? It's because that's what I started out with. And when I allocated maybe $2,000 for doing 10 contracts of this trade and a 2-point spread, I'm down to $1,200, but with this net credit here, it might help me repair it. So we're going to sell the 44. We're going to call it 170 bid, and we're going to buy the 46 and call that 95. Okay, let's sell at 170. We're going to buy at 95. And we're going to go back to 10, because remember, keeping that $2,000, it's now $1,200 after we take the loss. So selling the 44 call, buying the 46. Okay, so this gives us a max profit of $750. Why is that important? Because it was $100 more, $70 more than the bull put. Remember, if we rolled down to that 42.40 bull put credit spread, we took the 880 loss now on our current spread and rolled down to 10 contracts of the 42.40 bull put, we saw we would have only taken in 680. Here, using the calls, we can get a little bit better price, 750. All right, so now we'd only have a loss of 130 total, with the assumption that come October 30th, STX remains below this position. Okay, now if I wanted to see this graphically, how am I affected graphically? I'm just doing this by the numbers. Okay, this is what I would get for our 44-46 spread, converting it to a bear call. But if I wanted to see it, let's just add 88 cents to the ask price. So that would put me at, if I added 88 cents here, that would put me roughly at 183 for the long call. All right, so I'm changing the price because I'm factoring in the loss we already took. Okay, so there, with this bear call spread, if the stock does stay below 44, accounting for the 880 loss I took on the bull put, we'd have a max loss on October 30th of 130, assuming the stock stays below 44. But what happens if it goes above 46? We now naturally have a loss of 2130. All right, because we have to factor in the 880 we lost, plus the new 2-point spread we could lose. So we increase the risks to the upside if the stock covers against us, and we don't have a chance for a profit here, but we may be looking to continue to manage this, meaning that if the stock does stay below 44 now at October expiration, we only have a loss of 130. So depending on our sentiment on the stock at October 30th expiration, maybe into November, we look to do another bear call or bull put to make up this 130. Okay, so that's just one of the other alternatives, is liquidate and what we call do the opposite. Okay, so that's liquidate and do the opposite. So I started with a bull put, my sentiment has changed, I'm going to liquidate and take the loss and try to repair it with the opposite. What is the downfall of this particular adjustment? Well, it's quite obvious, isn't it? the stock recovers. Bottoms out next week, hits its low point, recovers, and then come October 15th or 16th, we see the stock back up at $45 or $47 per share. Now we're in the same predicament on the other side. Okay. All right. So let me just clear these out one more time. Let's review where we are very quickly. Let me do one thing here real quick, folks. I apologize. Here we go. Okay. All right. So that's my. Did I select the pen? I did. Okay. So chance one, liquidate and take the loss. No one wants to do that, but maybe it's better to look for other opportunities and try to make that up later on. You're wrong on the direction of the stock. And again, what I just mentioned is if I do this and I don't know what's going to happen next, I'm going to talk about that in about 5 minutes as well. If I don't know what it's going to do next, maybe I don't want to play this one anymore, this particular security. It's got me baffled. It's got me confounded. Let me just move away from it and go to somewhere else. All right. Number two, the common way, as I mentioned, anyone who's ever traded options and has a blog or has a newsletter that they want you to click on their ads for, they'll tell you the best way to manage a bull put is to just liquidate, roll the spread out to lower strike prices, in this case for the bull put, roll to lower and further out. Well, that can work, but you have to have the expectation that the stock is going to recover, that you've hit the bottom and the stock's going to move back up in price over the time frame that you've rolled out to. If the stock continues to move down, you can drastically increase your losses. In addition to the loss you already took, your loss to the downside by just moving it down further. If you lose on the next spread, as I mentioned, you're just catching the falling knife or standing in the way of the train if you're thinking about a bear call credit spread, okay? So this can work, but it does have downsides, and remember, you were wrong on the direction of the stock initially. So that leads us to, well, it's kind of out of place, but number three, we talked about creating the Condor. That really only is a useful repair if the stock hasn't moved too much after you've been in the trade. You still have a reasonable amount of time to go to expiration. You finish it off, you create the Condor. Sorry, let me write that out. Create Condor by adding the bear call to your existing bull put. In this case, it's not going to work because our original bull put, we're already well below it. Fourth way you might want to consider, these are all things I go through when I'm looking to manage a spread, by the way. The fourth one is liquidate and do the opposite. I liquidate and I take the loss on my bull put credit spread and I go further out to a bear call. Liquidate, I always put bear call, but that's liquidate and do the opposite. All right, we were wrong on the direction of the stock. It moved down. Maybe if we think it's going to continue to move down, we can try to use the bear calls now to hedge the loss in the position and maybe actually turn this into a small profit after one or two further bear calls after our October 30th expiration. All right. Number five. Number five, I'd say, are some of the elaborate ones. And I usually get a comment on these when I'm doing these webinars, and it's okay. We appreciate the comments. A lot of places out there now are advocating converting your failed spread into a more elaborate trade. By more elaborate trade, I mean something called a broken wing butterfly or a back ratio spread, adding a back ratio spread to a credit spread that's losing to try to get it back to break even. So I'm just going to call that elaborate, and we're going to take a look at one of those. Another way of looking at it is that to create a broken wing butterfly, I may be adding a bull call debit to my bull put credit or a bear put debit, more likely, to my bull put, which is a lot like creating a Condor. It really is. Broken wing butterfly repair is a lot like just creating the Condor. Doesn't work in the scenarios when we're below both. So let me just write that down. Five is what I call the elaborates. Okay. Now remember, what is being threatened here? It's my short put. My short put that I sold, the 44 put originally on STX, is the one that's being threatened. Let's go back to square one. Let me erase all the drawings here so we can clear it up. This is the one that's being threatened, the short put. That's my obligation to buy shares of stock at 44. We'll talk about that in 1 second too. All right, so the broken wing butterfly I might create here with having 1 week to go to expiration, as I may change now, go back to October 22nd, I may add more. Oops, no, I'm sorry, I clicked the wrong one. I may add more of the short options here and almost create a debit, a butterfly debit, by buying 46 puts. Is that going to work? I don't think so, but let's see. So what would I do here? I'm going to sell to open 10 of the 44 puts, 10 more. I already have sold 10. I'm going to sell 10 more. And again, we're going to call this now with a $1.53 to a $1.62. Let's just call it a nice round number of $1.58. And we're going to buy 10, but we're not going to buy 10 of the 46s. We're going to do a broken wing, meaning we're going to increase it here. And we're not really increasing, but we're going to increase it by going to 435, okay? This is an all butterfly position. 435 to 565, let's just call it 490, midpoint. Now I'm going to pay a huge debit to do this, by the way, this broken wing butterfly. Does it get me back to break even? Well, it gets me less of a loss here. Notice that. What a small loss here. We have a maximum profit now of 780 or 14.9%, but we have tripled our risk if the stock, of course, goes all the way above 48 now. My max risk to the downside is only 1220. That's what it repairs, is that it's trying to lower this risk to the loss in the direction that you're going, still give you a potential for a profit if and only if you think the stock's going to recover back to 44 or so, and then you could have a maximum loss on the upside. Another way to do this is sort of with the opposite, but with calls. So to create an iron, broken wing iron butterfly, I would sell 1044 calls and buy 1048. Well, that's exactly like doing the Condor repair, but it becomes a butterfly where you have a peak profit and loss chart. These are some of the elaborate ones I don't like to use. Some investors are creative with these, and some investors are successful. A lot of these, adding 3 more legs or 2 more legs to your existing position to try to create that condor or create that butterfly for a better premium, or the broken wing butterfly, because it's one of the buzz terms of the past 6 months to get a lot of internet clicks for people who are looking to sell articles on that. That's what they look to do. I call them the elaborates. It's not something I particularly use, but it's a possibility. But you're going to want to read up on those a little bit more because they're a little bit more complex, and you're essentially watching 4 legs now instead of just 2. All right, so let's go back to our main spread. 6th adjustment. This one might work in this scenario, but you're going to need help, okay? And the 6th adjustment, these are not necessarily in the same order I always teach them, but the next adjustment would be to, what is my issue here? Short put is the one that's in trouble. That's the one that's causing me losses. As the stock continues to fall, I'm going to lose. I run the risk of taking the maximum loss. But again, if now that I've looked at the stock, I've followed it since September 16th, I've been watching the trade, it's gone below my short put strike price with another $1.20 drop today, $1.18 drop today, so I'm now in between the strike prices. If I feel this stock is going to continue to move down in price, well, maybe I can try to do something creative. I only have 7 days to do it, but how about we just buy to close the short put? That's what's being threatened now that the stock has fallen. The long put's going to continue to gain value, but the put that we sold is going to gain in value more because it's going to be deeper in the money if the stock continues to fall, and that's the option we have to buy back. So what if we buy it back now? So let's go into View Options. Let's go to October 2nd. Let's click on our 44 put again, and we're going to call that a 158 cost one more time. So we're going to buy 10 at 158. Now we know that we took in 10-cent net credit. Buying it back at 158 is going to put us at a cost basis of 148 into the position, $1,480. But what did we just do? By buying it back now, we've created a long put. We essentially just own, now the way the system's showing it, the profit and loss chart is showing 2 transactions here. We sold to open the 44 and bought to open the 44 as well. Well, if we bought to open something we had sold, that would essentially close it. So we're now long a 42 put with a cost basis of $14.80 for 10 contracts, or $1.48. So in the next 7 days, if the stock continues down and drops below 40.52, we would now have a small profit, whereas we would have had the maximum loss on the bull put credit spread. So number 6 would be to buy the short and leave the long open. We can do this with credit spreads. Okay, because the long option in a credit spread will continue to gain as the stock moves against your original spread. So in the bull put, as the stock continually moves down against the bull put, the long put always increases. In the bear call, the stock moves against you, goes above your short call. If it goes above the long call, you hit maximum loss. But remember, if you close the short, you just have a long call. As the stock goes up, that'll gain in value as well. And this one, you need time on your side a little bit. I typically will only do this if I have 10 to 15 days remaining to expiration. 7 days left is very hard unless I really think this stock is just going to keep collapsing over the next 7 to 8 days. Okay, what's the risk here? Well, the risk here is what if the stock now recovers, goes back above 44? My loss to the upside is $14.80, which is pretty near the maximum loss, and about $500 more, $570, $80 more than the loss I'm taking right now by liquidating. Okay, so that's why we're talking about. It does depend on your sentiment of where you think the stock's going to go. This is just another repair. You always have to analyze when you're looking to adjust a position. I have another webinar I did. It's not related to spreads directly, but one of the other archived webinars is called Don't Roll for the Sake of Rolling. Okay, if the stock hits your trigger point and you think it's going to recover, you don't want to roll just because a trigger's hit, especially if you can't find a rollout that really matches. If I go through all of these, even though the stock is between my two strike prices on my bull put, and I'm at about 50% loss of what I would expect to take on the position, if I don't see an adjustment I like that really matches what I'm doing, most likely I might do nothing and leave the position open hoping it's going to recover. In most cases, though, I'm just going to liquidate it at that point and try to make it up somewhere else. If I can't find an adjustment that I like, that doesn't increase my risk too much, doesn't get me back to a profitable range, sure, I can see some repairs where I might get back to a profitable range. For example, I could buy this back, but if I don't have any expectation that the stock's going to be trading below $40 in the next 7 days and it might stagnate or recover, this repair is no good for me. Does as good as it looks on the positions, hey, I could make up to $40,000 if the stock drops down to $1 per share. Sure, a good likelihood of that happening, but you could do that. But if it doesn't match where you think the target price range is going to be over the next 20 to 30 days, or the next 7 days in this case, let's say this is your target range here, and that's probably less than that, it's probably between 44 and let's say 38. This might be okay in the 38 range. But if the repair graph you're looking at doesn't match what you're expecting to do and what you're expecting the stock to do going forward, don't just roll for the sake of rolling. Make sure it matches something that's going to get you to where you want to be if the stock does do what you expect next or think is going to happen next. But if you don't see anything, just move on. Liquidate, get out of it, and move on. Okay? So, but this one here, number 6, buy the short, leave the long open. If it continues to fall, you might realize a profit. Last but not least, the 7th way I look to adjust the spread positions, and there's actually 1 or 2 others, but the 7th way I might look to adjust the position is what I like to call the pendulum spread. Early, and this is the pendulum spread can work, usually works best if the stock is between the strike prices, as we're seeing in the example of our STX bull put credit spread. And what is the pendulum example? I had just spoken before about the issue that the short option, our pivot, is the one that's causing us the loss. Okay, as the stock fell below it, it's at a loss. Stock is bearish, we're in a bullish position. So if we're still bearish, how can we convert a bullish position, our bull put spread, to a bearish position? Well, we already talked about process number I listed as 4. Liquidate and do the opposite. Close both legs here, open a bear call, and then if the stock stays below it, you'll make a profit to kind of hedge the loss, okay? So that was number 4, okay? Liquidate and do the opposite. And do opposite, okay? Now, that would cost me commission, maybe 2 commissions to close my bull put, another spread commission to open my bear call, okay? Because you can't roll a short put into a short call in most brokerages. So that's not a roll, okay? You got to buy to close this and sell to open another one. You're not really rolling, okay? But what if I just create a bearish position? And remember, my profit on a bearish position exists when the stock is going to be trading below the short put or the short call. Or if I was in a bear put debit spread, if the stock stayed below my short put, the bear put debit spread would be profitable. Well, I've already got the short put, but I've got a long put that created a bull put credit. How about I sell to close my 42 put and roll it and buy to open a 46? Your broker would just count that as a roll. So you're essentially just paying the roll commission instead of buying to close one and selling to open the other. You usually get a discount at that. But what am I doing here? I'm swinging my profit leg from there to there. Okay, so we're going to close the 42 put. We're going to sell to close it for the increased premium. We're not going to touch the short put, and we're going to buy to open an in the money 46 put. So we're swinging the pendulum from 42 to 46. We're turning a bull put credit spread into a bear put debit spread by just adjusting one option. Will it work? Well, that depends on the cost of the 46 put, the cost to buy back the what we're going to receive for this 42, the cost of the 46, and the difference in the strike prices. Because we only collected a net credit of 10 cents up front, I don't know if this one's going to work, but let's see if it would. So what do I have to do first? Well, go to October 2nd. We're going to keep the same expiration. I'm going to buy to close the 42 put. We see it's at 58 to 63. So let's just call it 61 cents. It's 60 cents. Let's just be nice to ourselves. We're going to buy 10. I'm sorry, we're going to sell to close 10 at 60 cents. Then we're going to go to the 46 put. We're going to buy to open. It's a 50-cent bid ask here, 310 to 360. Let's call it 25-cent midpoint. So we're going to buy to open 10 46s at 335, right? Yeah, 335. All right, so really what we're paying here is, as you can see, it is going to be $2.75. I can tell you right now this is not going to work, but let's give it a go. Okay. Didn't do what we wanted to. We're still at a loss of $6.50, which is less than the $8.80 we have right now, but it didn't really do what we wanted. How did I know it was not going to work? Well, it's because that difference that I saw. We're selling to close the one put for 600, buying to open the other, or 60 cents, buying to open the other one for 335. So that was a debit of 270. Okay, and we kept the 10 cents essentially we received. Okay, but we're doing a debit of 275, but we only have a $2 strike difference. Okay, so that means that I'm still at a loss here of this, what would come out to be 75 cents. Well, times the 10 contracts is 750. Minus the 10 cents times 10 contracts or $100 we kept, we're at $6.50. I need this new debit, the difference between selling to close my 42 put and buying to open the next put, the 46 put in this case. I needed that debit, which was $2.75, to be less than $2 in order for this to work. Could we go higher and maybe try a 5-point spread? We could. I don't know if that's going to work either, but let's go ahead and do it. Instead of buying the 46 at 335, let's go to October 2nd again. Let's try to buy that 47 put. I'm sorry, there's a 2-point strike difference from the 44. I need to go to the 49. That's not what I want. I need to go to the 49, 470 to 675. Let's call it even $2. So $1 midpoint, so 570 ask. Let's clear that out. I'm going to buy 10, 570. What's my difference in strikes here? What's my debit here is under $5. No, it's at 510. I'm sorry. So with an ask of 570, taking in 60, it's a debit of 510. But the 44 to the 49, my new debit, that has to be greater than, I'm sorry, the debit has to be less than 5 points for this to work. There's still going to be a 10 cent or $100 loss on the position, okay? Doesn't show anything. It's a wipeout. Again, because the full debit between these two, the 510 on the pendulum adjustment, the 510, and we've now created a bull bear put debit that has a 5-point difference. So we're still behind the 8 ball by 10 cents, but we keep the 10 cent initial net credit from the bull put, and so max profit of 0. Okay, but in most cases when the stock is has fallen against you, it's gone between the two strike prices, and usually right between the two strike prices, sort of right between the middle two. The pendulum adjustment is a potential idea. So as the stock continues to fall down in price, you may still see a profit by converting the bull put to the bear put debit by just swinging the long option to create the bear put debit, called the pendulum adjustment. And as the stock stays below the short put now, you'll have a profit, and you only had to pay one extra commission to roll one leg instead of trying to do a conversion of liquidating this and buying a whole new spread or selling a whole new spread that's way out in time, or liquidating this and selling a bear call that's further out in time for another whole spread, or trying to add a multi-leg spread to create a broken wing butterfly, broken wing condor, whatever you want to call it, to try to repair your existing spread as well. All right, so real quick review. 1 through what I listed 7 today. Okay, so number 1, liquidate and take the loss. No one wants to do it, but sometimes we just have to admit that we were wrong on this stock, and if we don't know what it's going to do next, we don't like the other adjustments, maybe we just take this loss, hopefully try to make it back up somewhere else. Number 2 was liquidate. Most common one, I think, is liquidate and roll down. Okay, well, it has its pros. You can just roll down, get a better probability. You're going to have to roll further out. You're going to roll down and out. So you can probably get close to repairing it. And you now are going to be in a position maybe for an extra 30 days or 60 days to get the repair done. But you were wrong on the direction of the stock. If it still continues to be bearish, you might lose on both positions, in this case from the bull put. Number 3, create the Condor. I don't even know, we talked about that in depth. It's not something that works in this scenario. If it's stagnating and you can create the Condor because you think it's going to stay within 2 strike ranges, that works. But doing the opposite, not liquidating, but just doing the bear call now to create the Condor, not really good in this scenario at all. Number 4, liquidate and do the opposite. We saw a little bit better premium by going out to October 30th series and doing a bear call that had a decent probability on the position to help repair it. It did better than liquidating and rolling down the bull put, especially if the stock continues to fall. Number 5, those are the elaborates. Okay, you can probably go on the internet. I don't have a lot of information on doing this at PowerOptions. I've looked at a lot of these trades. The reason why they're useful, believe me, they can work. This is the creating multi-leg positions, broken wing butterflies, broken wing condors, other things of that nature to help prepare your existing spread. It gets complicated, more commissions. On this one, since we only collected 10 cents to begin with, we saw that really high 95% probability. Not sure if that's the way to go, but I do know customers who attend my webinars regularly, or used to attend my webinars regularly, a few that still do, that doing the broken wing butterfly repairs, adding a debit spread to repair the credit spread and so forth by creating a similar condor, creating a butterfly, they have had that work in the past. Of course, it can work. Any of these repairs can work, provided that the stock continues to go in the direction that the repair would satisfy. Okay, that's also key. Okay, number 6, buy to close the short, leave the long open. Usually want to see 10 to 15 days, and I really want to have a strong direction that the stock is going to continue to move down in price. Okay, so you buy to close, you leave long open. And then just number 7, because I ran out of room, is the pendulum adjustment. You can see another example of that in the webinar I pointed to earlier on managing your spread positions. This one might actually not, this webinar today might actually not be posted in the standard area of the requested topic screen where we usually post our open discussions because, well, we just spent the whole hour or so discussing managing a bull put credit spread. So in addition to the managing your spread positions, this webinar might appear beneath that, managing your bull put credit spreads, because that's what we focused on. Okay, so the pendulum adjustment and the other webinar shows that as well. All right, so Robert, those are my preferred ways and what I might look at to, and again, they're not in the proper order because as I mentioned, I rarely do number 3, and number 5 I tend to never look at unless I'm at a complete loss. So normally what I look at is liquidating, but that's always in my mind. Right? When a spread goes against me, the first thought is I know going in, if I liquidate, what is my loss right now versus what I could lose at expiration? That's what I look at first. And I look at that first just so that when I go through all of these other opportunities, liquidating and rolling down, liquidating and doing the opposite, buying to close the short, leaving the long open, or the pendulum adjustment, I'm looking at what is the risk reward of each of these, what is the after effect of each of these potential adjustments compared to what I would lose right now and what I could lose in the next 7 days if I leave the position open and the stock takes the spread, takes the maximum loss. If I don't like any of these 4, liquidating and rolling down and out, liquidating and doing the opposite, closing it and then doing a bear call spread, buying to close the short to leave the long open, or the pendulum adjustment, maybe then I'll look into the elaborates. But again, the create the condor is really only if the stock is still above my put strike price or my current spread is still out of the money and I need some extra premium just in case I fear it's going to fall. Now, one other thing I have to add, in addition to all of this that we just went through, I can tell you right now that most likely if I was in this bull put credit spread on STX, and if the position is where it is, and I had to evaluate this, I probably wouldn't liquidate and roll down and out to October 30th. I probably wouldn't liquidate and do the opposite to October 30th. I might buy to close the short and leave the long open, and then maybe put more money in to buy a long call. And I don't think I would do the pendulum adjustment. I highly doubt I would do an elaborate, and I definitely would not create a condor. Can anyone guess why? That the only option I might consider right now, if this was a spread I was in, even though I'm coming up to expiration 7 days away, okay, why I would likely not do any of these other adjustments, why I might consider just buying to close the short, leaving the long put open for 7 days, and then evaluating it a little bit after that, okay, evaluating the position afterwards. The reason why, of course, is that these adjustments here were predicated to try to find a good credit to manage the position. We probably even had to go further out to November. But the adjustments of liquidating and rolling it out, liquidating and doing the opposite, or even the pendulum adjustment. Pendulum adjustment didn't give us what we wanted. I'll be honest with that. It didn't give me the premium I wanted, so I wouldn't do it. But these other ones, even creating the Condor, were all predicated on going out to October 30th or further to get the credit we wanted. Why is that a problem? Because any directional spread with an expiration of October 30th is going to have to probably pass through the next earnings for STX when the stock could swing wildly one direction or the other. We have no idea. I typically never want to be in a directional bull put or bear call credit spread going into earnings or having an expiration after the earnings event because I don't know what's going to happen. I don't want to get stuck with a position that looked like it was going to be really profitable, and then I wake up in the morning and the stock's down 25%, my bull put's at maximum loss, and I still have 20 days to go. Okay, that's why I wanted to avoid it. So even with the repairs, it's just like opening a position from brand new. Even doing a repair, I don't want to repair where I end up in another directional trade where that directional trade would go through earnings. Okay, so if I just roll down the bull put to 1030, if we have earnings coming out on 1024 or 1027, I don't want to be in this position where the risk here is almost double what original loss was, or liquidating and doing the bear call. I don't want to do that with an expiration of 1030 either. That does give credence to maybe I should have been looking at 1023 or 1016, but we saw that the credits were so low that the repair wouldn't have worked anyway. Well, it would have worked a little bit, but we would have hedged what's now an 880 loss down to a potential max loss of 650, even if the stock went in the direction of the repair. Okay, so that's not a valid way to repair that position. So I buy to close the short, leave the long open. And on Monday, if the stock continues to move down, and then on Tuesday it continues to move down, maybe I'll look to adjust this. If the stock starts to move up on Monday, then I'll probably just close this too, and then I'll try to look for new positions to make that back up. If the stock falls enough to where I'm almost at break even on this position, and we're now on October 5th or October 1st or September 30th next week, maybe I'll do a straddle or strangle if I have some value in the position. Maybe I'll just roll this one out to a 42 put for October 30th and then maybe look to buy an out of the money 48 call, create a little strangle, and see if I hold it through earnings on the 30th, or on the 24th or 25th, maybe 26th or 27th, if that gives me any bang for the buck. Okay, because earnings do come into play when you're doing an adjustment. Just like when you're opening a brand new spread, don't roll for the sake of rolling. Make sure you know what's going on with the stock before you just roll the position out in time, because you don't want to get yourself crossed over by trying to repair this. Let's say I entered another bull put here, earnings come out and the stock collapses. My risk was twice, or at least maybe 50% more than what I would have taken had I just liquidated the position at 880 today. Okay, so that's my last little tidbit there on the management. Didn't want to mention it first because I just wanted to see what everyone would think about that and how everyone would see that. With these are the ways that I look to roll the positions in my personal portfolio, the credit spreads that might start moving against me in my personal portfolio, but I always have an eye to what is the stock doing now, what does it look like the stock's going to continue to do, and of course, do I have earnings or an ex-dividend date or something coming up between now and where my repair is going to be. That might dissuade me from doing any of the other repairs that we just talked about, number 2, number 4, and number 7, and even probably number 5. Okay, all right. Well, that takes us to about 5:50 p.m. Eastern Time. I'm just going to navigate back over to our slide positions. We will post this webinar as I mentioned. Oh, sorry, folks. Let me get back to where I need it to be. There we go. And that'll be in that free webinar section. You can access the free webinars at any time. It's a public page. You don't need to be logged in. You can just go to www.poweropt.com/webinars.asp. Here you go. And this will be under the Option Strategies tab, and it'll be Managing Your Bull Put Spreads. I likely will not get a chance to post this recording until sometime tomorrow afternoon, Saturday afternoon. But it'll be up there then, and we'll send everyone an email when the webinar has been posted. Just leave these up here for now. If you're not already on your 14-day free trial, remember you just go to PowerOpt.com, put in your name and email address, and register for the 14-day free trial. After your 14 days, our levels of service, our 20-minute delayed service is $60 per month. It gives you access to all of the patented search tools and analysis tools, the portfolio and the custom spread tool, and that's $60 per month. You can also upgrade to the historical level of service. We have historical data going back to 2006. So the 20-minute delayed access with the historical backtesting tools, $40 more, it's $100 per month. A real-time service, so every time you run a search or refresh the page, you're getting the numbers and calculations at that very instant. That's $100 per month. And then, of course, you can also add the historical to the real-time. So the real-time and historical is $140 per month. There's annual discounts available as well. All right, and right now, of course, we are also offering another level of service. It's called the end-of-day service. It's just updates once per day. Still gives access to the search tool and the portfolio tools, but you only get end-of-day data, so you only see an update once a day. And in this market, personally, I don't even think that's enough, even if you're doing protective strategies like I am. I would have missed the opportunity to adjust Cal-Main today if I only had the end-of-day data. But it's available for those of you who are just starting out, and the end-of-day data service is only $40 per month. Ladies and gentlemen, thank you for joining me today. I hope you all got some useful information on the bull put credit spreads and the management techniques and my process in doing so. I encourage you to do further research. You might want to run a search. I'll be honest with you, just to take a look. You'll probably see a lot of these pop up, but if you run a search for credit spread repair a credit spread on Google or any other search engine, you might come across some of those articles I mentioned about the elaborate spreads, about converting a credit spread into a broken wing butterfly or broken wing condor or things of that nature, or adding a back ratio spread to repair a credit spread. It'll just give you some more insight of the risk and reward and what's available. I just want to make sure that you cover all the bases so you know what's out there. I personally don't do them. I think they're too complicated, even for me. But a lot of investors use them. A lot of people are teaching them. A lot of investors use them with some success. A lot of investors use them with no success. But again, I hate to say it, that's just like any other repair at that point. I can make any repair I want to on any position. That doesn't mean it's going to repair it. I still probably need the stock to go in a direction to fix up for it. But if you do think of any questions later on, send me an email to support@poweropt.com. Remember, you can also call us during market hours at 302-992-7971. There's also contact links on the bottom of every Power Options page. Thank you once again, ladies and gentlemen, for joining me. Have a fantastic weekend. We'll see you next week for some of our other online webinars and live presentations. Happy trading. Good night.